You did everything right. You bought the policy, you paid every premium on time for years, and when your family finally files the claim, the insurer says no. It sounds impossible, but a life insurance policy is a legal contract, and there are a handful of quiet mistakes that let the company refuse to pay the exact people you bought it to protect. None of them are exotic. All of them are avoidable once you know what they are. You have followed Marcus through this whole series. He did it right. He built his number, he bought $500,000 of level term for about $25 a month, and he refused every upsell. But a policy is only protection if it actually pays out when his family needs it. So let us walk the last mile with Marcus, the mistakes that can quietly void that payout, and how he sidesteps every single one. Quick note, this is how claims generally work, not legal advice. Your policy's terms govern, so read them and ask your agent. Start with the reassuring number, because the fear selling gets this backwards. Insurers pay the vast majority of life insurance claims, well over 99% of them. Denials are rare, and a denied claim is almost never bad luck. It is one of a short list of avoidable mistakes, and every one of them happens long before anyone ever files. So this is really a checklist for the day you buy, not the day your family collects. Here are the 4 that account for almost every denied or misdirected payout. 1. Fudging or leaving out facts on the application. Your health, your smoking, your income, a dangerous hobby. 2. Assuming you are automatically past the contestability window. The first 2 years when the insurer can still go back and check. 3. Letting the policy lapse by missing premiums, so the coverage is simply gone when it is needed most. And 4. An outdated or wrong beneficiary, which can send the money to the wrong person or into a court process. We will take them one at a time. And this is not opinion. It is straight from the regulators and the industry. The single most important one to understand is the contestability period. For the first 2 years a policy is in force, the insurer can investigate a claim, and if it finds you misstated something material on the application, it can deny the claim or cut the payout. After that, the policy becomes incontestable for honest mistakes. They can no longer void it over an application error. So the lesson is not to lie for 2 years. It is that being honest on the application is exactly what makes the policy bulletproof later. The beneficiary mistakes deserve their own list, because here the insurer does pay, just to the wrong place. 1. An ex-spouse still listed as the beneficiary years after the divorce. The company pays whoever is named on the form, not who you meant. 2. Naming a minor child directly. An insurer cannot hand a large check to a kid, so it goes to a court-supervised guardian instead. 3. Leaving it to your estate, which drags the money through probate and can expose it to your creditors. And 4. Naming no backup or contingent beneficiary, so if your first choice has already died, the payout falls back to your estate anyway. Sourced, as always. Quick pause. If making sure your policy actually pays is worth 2 minutes to you, hit subscribe. This is the whole channel. The honest mechanics with none of the fear selling. Okay, back to Marcus and the fixes. So here is how Marcus keeps his payout airtight, and it is genuinely easy. 1. He answered every application question fully and honestly. No shading his weight, his driving, or the occasional cigar. 2. He put his premiums on autopay with a backup card, so a missed bill can never quietly lapse the policy. 3. He named a primary beneficiary, his wife, and a contingent one, his brother, so there is always a valid recipient. And 4. He set a reminder to recheck his beneficiaries after every big life change. A marriage, a divorce, a new baby. That is the entire defense. There are a few genuine exclusions worth knowing, and they are narrower than the scare stories suggest. 1. Suicide in the first 2 years is typically excluded. After that, it is usually covered. 2. Dying while committing a crime or from an illegal act can void a claim. 3. Undisclosed high-risk hobbies or travel. If you fly small planes or scuba dive and never disclosed it, that can be a problem. But notice the pattern. Almost everything else, natural causes, illness, accidents, is exactly what the policy is built to cover. The exclusions are the edge cases, not the rule. As always, straight from the source. So here's Marcus, fully done. He answered honestly, so the contestability period holds no surprises. He is on autopay, so the policy will never lapse. He named his wife and his brother, so the money goes exactly where he intends, with no court and no probate. If the worst happens, his $500,000 will actually arrive, in full, for the family he bought it for. That is the whole point of this series. A policy is not a payout until you make sure it is. Marcus did. That completes the core of this series. You now know how life insurance works, what it costs, how much you need, how to buy it, and how to make sure it pays. So the next one is your call. Do you want the deep dive on riders and which are actually worth paying for? On life insurance for stay-at-home parents? On seniors and final expense, worth it or a trap? Or on whole life sold as an investment? The hype versus the reality. Tell me in the comments which one you want first, and that is the one I build next. And subscribe so the one you pick shows up in your feed the day it goes live. Thanks for watching this whole series. Go make sure your own policy is airtight, and I will see you in the next one.